All right, let's talk about DeFi. It's this massive, kind of revolutionary idea that's trying to completely rebuild the world of finance from scratch. So let's just dive right in.
Think about your bank for a second. You know the drill, right? The delays, the fees, the layers of middlemen. Well, DeFi starts by asking this really radical question. What if we could just get rid of all of that and replace the entire system with pure, transparent code?
And when you look at it like that, the difference is, well, it's night and day. Traditional finance often feels slow, it feels expensive, and let's be honest, it can feel like it was built for insiders. The big promise of DeFi is a system that's open to literally anyone with an internet connection, running 24/7 at the speed of software.
So what is it really? The simplest way to put it is that DeFi is a whole parallel financial system. But instead of, skyscrapers and boardrooms, it's built on the blockchain. And it's all run by these pieces of self-executing code we call smart contracts.
And this right here, this is the fundamental shift. In the old world, you have to put your trust in institutions, in people, in companies to do the right thing with your money. In DeFi, you don't trust people, you trust math. You trust verifiable code that anyone, anywhere can look at and check for themselves. So how do you even start building something like this? What are the core building blocks you need? Well, it all has to start with stable money, right? You can't build a system for loans and trading if the very assets you're using are jumping up and down by 20% in a single day. The answer to that problem is stablecoins. These are a special type of crypto token, and their one job is to hold their value. They're designed to be pegged, usually 1-to-1, with a stable asset like the US dollar. The goal is simple. One token always equals $1.
But, how do they actually do that? Well, there are a few different flavors. You've got your fiat-backed ones like USDC, where for every digital dollar, there's a real dollar sitting in a bank. It's simple, but it's also centralized. Then there's crypto-backed coins like DAI, which are decentralized, but they're not very efficient. You have to lock up way more collateral than you get in return. And then there are algorithmic stablecoins, which historically have had a really bad habit of, collapsing.
This is honestly the best way to think about them. Stablecoins are basically the poker chips of the DeFi casino. They're what you use to get in the game, to trade, to take profits, all without having to cash out and go back to a traditional bank.
Okay, so we've got our stable money. Now for the really interesting part. How does trading actually happen without a New York Stock Exchange? This is where DeFi just flips the whole script.
See, instead of the old-school way of matching up buyers and sellers in what's called an order book, DeFi uses something totally different, an automated market maker, or AMM. It's a system powered by these big pools of assets. And the easiest way to get your head around this is with a super simple analogy. Just picture a robot. And this robot is holding a bucket filled with two different assets. Let's say Ethereum and USDC. Now, this robot is programmed with one very simple rule. It will always trade with you. No questions asked.
So here's how it works in practice. You walk up to the robot, you put your USDC into the bucket, and you take the fair market value of Ethereum out of the bucket. That's it. Based on the new balance of tokens left in the bucket, the robot instantly recalculates the price for the next person in line. It's all completely automatic. So this begs a pretty important question, right? Where does the money in the bucket come from in the first place? Well, it comes from you. Anyone can deposit their assets into that pool. And the moment you do that, something really profound happens. You stop being just a customer, you actually become the exchange.
And why on earth would you do that? Well, there's a pretty big incentive. For providing that money, that liquidity, you earn a tiny slice of the trading fees from every single swap that happens in that pool. And those little fees can add up, which is how you see these yields that can sometimes blow traditional finance out of the water.
But, and this is a huge but, being the house is not free money. There's this unique kind of weird risk called impermanent loss. Think about it. If the price of Ethereum skyrockets, traders are going to rush to the robot to buy it. You're earning fees on those trades, which is great, but you end up holding more of the less valuable asset, the USDC. It's called impermanent because if the price goes back down, the loss disappears. But if it doesn't, you might have actually made more money just by holding onto your coins in the first place. That's the trade-off you make.
And this all brings us to the reality of where we are right now. For all of its amazing innovation, DeFi is still very much the Wild West. It is jam-packed with incredible opportunity for sure, but it is also filled with some very, very real dangers.
You've basically got three main monsters lurking in the shadows that you absolutely have to know about. There are bugs in the code itself, there are outright scams from the creators, and then there are tricks that are designed to target you personally.
First up, smart contract bugs. This one is tough because the code that runs everything is written by humans, and, well, humans make mistakes. A single tiny flaw can be found by a hacker and exploited to drain every last penny from the entire system. You can do everything right and still lose it all.
Next, you've got the inside job, the classic rug pull. This is just plain malicious. It's where a team builds a project that looks legit, but they build a secret backdoor into the code. They wait for people like you to deposit money, and then poof, they use the backdoor, steal everything, and vanish without a trace.
And finally, we have phishing scams. These are the ones that target you directly. It could be a fake website that looks real or a bad link somebody sends you. They're designed to trick you into signing a transaction. You think you're just approving a simple trade, but what you're actually doing is giving a scammer permission to empty your entire wallet.
So, after hearing about all these risks, you might be thinking, is this whole thing just a high-tech, unregulated casino? And that's a fair question. But the people building this stuff believe it's evolving into something way more profound, the actual back-end infrastructure for the entire global economy.
The key to making that massive leap is this concept called real-world assets, or RWAs. The whole idea is to build a bridge between the digital world of DeFi and the value locked up in physical, real-world things, like real estate, art, and government bonds.
And this isn't just some sci-fi fantasy. I mean, imagine buying a token that represents a 1% share of an apartment building, and then getting your piece of the monthly rent deposited directly into your crypto wallet. Or earning yield from US Treasury bills right there on the blockchain with no brokerage account needed. This stuff is already starting to happen.
And that really leaves us with the fundamental choice that DeFi puts in front of all of us. It forces us to ask what we really value more in a financial system. Is it the perceived safety and stability of a traditional bank, with all of its walls and its rules? Or is it the absolute, permissionless freedom and efficiency of code, with all of its sharp edges and its risks? That's the revolutionary trade-off.